Hola, Barcelona. Thank you very much. So thanks for coming today. And I immediately ask all of our panelists to the stage, please come up as well. There's one small change. Robin from Nomura is unfortunately not able to come. So we have Aya from Falcon X jumping in. Thank you very much for that. And thanks, everybody. So I think it would be the best thing to start with a very quick introduction round. And Aya, ladies first as well.
Sure. Yeah, so my name is Aya. I lead institutional coverage at Falcon X, so head all of our sales trading. Falcon X is a crypto prime brokerage, managing trading, clearing, and credit for some of the largest institutions into crypto.
My name is, whoa, powerful one. My name is Carlos Domingo. I'm the CEO and founder of a company called Securities. We specialize on issuing and managing and trading digital asset securities. These are tokens that represent regulated instruments, whether they are equity, debt, or revenue share, or staking rewards, or other type of tokens that most regulators will qualify as securities. And we have a number of SEC licenses in the US that allow us to basically issue these tokens and manage them and trade them in a legal way.
Hi everyone, my name is Seena Foroutan. I'm one of the directors of business development at Chainlink Labs. My team, we focus on building new markets, frankly, and things that aren't necessarily Chainlink Labs' core business. And so, yeah, happy to be here and thanks for the time.
Hi everyone, my name is Andrew Wishart. I work for SDX. I lead the sales initiatives there. I have been there since about 2019, so pretty much since the build-up of it. We have two parts of our business meanwhile. One is the financial market infrastructure, which is regulated. So we've basically built a permission market in that sense, a regulated permission market in Switzerland. We've got licenses, a stock exchange license, and we also have a CSD license. For those of you who don't know what that is, that's a central securities depository, so the main register in Switzerland. And the other side of the business that we're running is now we're getting into crypto. So we're also building up staking capabilities, which is kind of in our DNA, because given that we're an FMI, it makes sense to build infrastructure for this new emerging kind of asset class. We're also getting into custody, and we'll be doing a lot of other things in the crypto space going forward.
I can't match that, so I think I'll just be quiet. Nice job. Cory Pugh, Bridge Tower Capital. We are an infrastructure company in the blockchain based in Zurich, Singapore, in the US and in Latin America, involved in staking and different financial products, as well as permission markets with several of the group here. So we're privileged to be here.
Thank you very much, everybody. Aya, thanks again for jumping in, and I also would like to start with you today. I think it was 2 days ago, right? You have been here on stage on on what was the name of the panel, institutional adoption as well, and you talked about the need currently for innovation around identity and how this could enable the next stage of DeFi. Would be great to hear a little bit more about that.
Yeah, sure. So today, as it pertains to what are the obstacles for institutions across the board and defining institutions in there specifically, so primarily thinking about investment banks, asset managers, very large asset managers, endowments and foundations, hedge funds, venture funds, and systematic funds. So the main obstacle for institutions to get involved into this space and in DeFi is the travel rules, specifically in the United States. So know your customer on the other side. And so one of the concerns there is just identity as it pertains to who is the person on the other side, either taking or making liquidity for you. And so, one of the things that has been very top of mind as more and more institutions enter this space is how do we do so in a regulated way that's scalable for us? And that's really the largest umbrella, especially with the folks on this panel who are highly regulated. They're the folks who are seeing a lot of the institutional adoption into this space, which is exciting. And so how do we create the rules and regulations for institutions to comfortably enter the space is one. And the second is whether we solve identity or don't solve identity, how do we create interesting yields and returns that are worth the risks associated with entering the space as well. So if you're going to take risk with a new technology or with unclear regulation, then typically a yield that is roughly 10% isn't going to be interesting enough for someone to be able to really go through the process to do that. Typically, you see institutions get really interested when the yield is over 20-25%, and you start to see a lot of time and resources spent into actually learning how to be able to get over that hump.
Awesome. Thanks a lot. Carlos, next question to you. You announced last week that your securitized ID solution will be natively integrated to Avalanche, and this is more or less building directly on what Aya just described, right?
Yes, so because we have always been dealing with tokens that represent regulated entities since the very beginning, we've had to figure out how to attach an ID to a wallet, right? Because once, and by the way, this is happening in crypto as well, right? Like if you go to Coinbase, you have to do KYC, and they'll know what crypto you have, and then with the implementation of the travel rule, they'll have to figure out how to share that KYC information back to when you move your crypto out of the exchanges, right? So this is coming in crypto as well. But in the space of digital asset securities, this has been there from the very beginning, right? You can't sell securities or trade securities without people you don't know who they are. There's a lot of regulations in terms of, trading restrictions, some retail, some not, in terms of like not trading with sanctioned countries, which now is a popular topic of discussion about, what happens with DeFi if somebody that is sanctioned can go to DeFi and then trade their assets there, etc. So what we have done is we have this ID solution that has around 450,000 investors that attach wallets to it, and we support multiple blockchains. We support Ethereum, Avalanche, Algorand, now we're adding Polygon, etc. The next iteration of this, what we did, was to issue an on-chain attestation that a particular wallet has been KYC by us. And the rationale of this is the following, like the DeFi companies or people building, decentralized protocols for different things, they don't want to deal with KYC, right? KYC is a very difficult thing. It's not about like I get a tool and I scan a passport of somebody. But you have to have a compliance team. You need to know when to intervene, when to reject something, when to manually do something, etc. And then you also need to be prepared for regulators potentially coming to you and telling, asking you how did you KYC this person and why this person was approved. And because we're a regulated entity, we already have those things in place, and we've done it for thousands of people. So the idea is that we will take the burden of the regulations. We'll do the KYC. We'll issue this attestation on chains, and then if you're building a DeFi protocol, you don't have to worry about KYC because you will know, looking at the blockchain, that wallet has been KYC, let's say by Securitize, with certain permissions for you to be able to trade with them. So it basically eliminates the need to do that. And what we announced last week specifically is that we're going to be working with Avalanche on issuing a number of subnets that are actually permissioned, in the sense that all the wallets have been filtered out by, let's say, whitelisters that are regulated entities like us, or other ones if they want to join. And then anybody transacting on that subnet will have all the advantages of Avalanche, the speed, the security, the EVM compatibility support, etc. But they will also be on the safe side of things, that making sure they're not facilitating trading with anybody that they should not be trading with because it's a sanctioned country or a politically exposed person, etc.
This is amazing. I think this is super helpful to bring Avalanche really on a global scale as one of the leading layer ones.
I think Avalanche has a particular advantage compared to other blockchains, is that Avalanche has this concept of the subnets, right?
Yeah.
So Avalanche itself is a subnet, right? So you have the P chain, which is the platform chain, and then you derive the C chain, which is what everybody thinks of Avalanche when they think about it, which is just one particular subnet that happens to have EVM compatibility and support the same smart contract language that Ethereum has, and this is why it has taken off very quickly. But there's another one for payments, and then now they have launched this very big initiative to create more subnets. And the advantage of the subnet is that it allows you to move assets across the different nets, but it's also secured, if you want, by the underlying platform chain that secures all the other subnets. But you can then create subnets for specific use cases, like the ones we're doing for regulated DeFi, for security tokens, etc.
Talking about exactly these use cases, Cory, you have been on the stage here also 2 days ago, together with Tim Grant from Galaxy, and you announced your permission market. How important are these ecosystems and the partnerships for you?
So it's interesting. A good part of this group here makes it possible for us. So we start out with staking, and we looked at staking and we thought, okay, you can use custodians, we can do some great things. And we thought about the evolution of a product and how you create the product. And as Carlos spoke about, as Aya spoke about, securities and utilities are very different. And being on the more conservative side, we said there are certain products that we believe are securities. And so we want to ring fence them. And there's a lot of groups doing KYC, which is wonderful. And that's certainly where, we partner with Securitize many times, but on the Securitize ID, we can have one landing page. You can go in, go through the KYC through Securitize ID. You're inside this wall now. Everybody is, you know who you're dealing with. The permission market is, Carlos spoke about, and Chainlink's going to come up here in a minute. You've got a couple of things. You have proof of individuals, but you have counterparty risk, and you have proof of reserve. And the proof of reserve that Seena is going to talk to is extremely powerful. So for us, the permission market, Avalanche, obviously EVM compatible. You can now create interoperability between multiple chains with those integration points, as long as you have the proper construction of a product and it can move seamlessly. And we have full visibility and transparency of what we do.
Awesome. Andrew, coming to you, representing Switzerland here. I think we all know Switzerland as it's the home for a lot of foundations, for the majority of the foundations, and it's a crypto valley. The SDX, the Swiss Digital Exchange, is a subsidiary of the Swiss National Exchange. So I think you're one of the first, next to Securitize, one of the first security token exchanges in the world. And how do you trigger, or how do you currently try to avoid the fragmentation of liquidity and have an interoperable permission market ecosystem?
Yeah, so that's quite a challenging question, actually. But what I would say is what we've started with is sort of laying a foundation. And one of the pieces that we need to do first before we go into demystifying the whole fragmentation of liquidity, etc., is actually sort of creating, because it is about bringing institutions into the digital asset space, or at least that's what it is for us. You need to create a comfort level whereby they feel that they've got the means and familiarity with being able to do the business the way they've been used to do the business. So for example, if you look at liquidity today, I mean, the cost of liquidity has actually gone up. So probably for them, their balance sheet is more concerning than actually maybe some operational effectiveness or operational efficiencies that actually this great blockchain technology brings to the table. So it's about navigating and bringing these kind of, let's say, spectrums from either side together in order for the adoption to sort of take place. And then the next thing is, of course, if you're creating a market whereby you are looking to actually have a value proposition which attracts institutions into it, you need to be able to have an asset or a product that draws them in, which they're willing to sacrifice a little bit of these liquidity maybe constraints, or more liquidity will come in from these institutions in any case because they've got an attractive asset to be trading with.
And Seena, Chainlink and CCIP, this is the key for everything, right? Chainlink is linking everything together?
Yeah, so at Chainlink, we're working on our cross-chain solution referred to as cross-chain interoperability protocol, or more commonly known as CCIP. And this will allow us to not only transfer tokens cross-chain, but everything from communications, documentation, identity, and anything else that we want to truly enable what we consider cross-chain and hybrid smart contracts. So folks can utilize the networks and ecosystems that benefit the exact use cases they're trying to achieve. So we start on Ethereum, we use a layer 2 rollup to do identity, we want to do cross-pollination with another layer 1. That can all become possible because Chainlink's Oracle network is going to actually be the mechanism that facilitates and secures all the value between all this. It's not an easy problem. It's quite a hard problem, but we're taking on the challenge and think it's going to be very exciting once it's launched and available to market.
Amazing. Aya, you mentioned the different personas, right? You have a 50 billion asset manager, you have family offices, so the customer, the segments of institutional investors is quite different. What do you at Falcon X currently see? Where's the demand and where are the institutions?
Yeah, so even taking a step back, why is all of this important today, and for what institution? So if you have over $150 million in assets, you have to get regulated as an RIA in the United States, which means the way you are audited and how you account for the assets on your balance sheet is reported in a very different way, and you have to have different processes for that size of a fund. And so it's so important. That's why KYC is important. But it's not just important for institutions, it's also important for everyone in this room, because the only way that you can get fiat in or out of the crypto ecosystem is typically through KYC to your bank account. And so because today you can't purchase coffee with stablecoins, you still have to have KYC in order to go ahead and move money into and out of the space. And so it's still very, KYC and this travel rule, identity in general, everything we spoke about is applicable not just for the large $50 billion asset manager, but really every single person in this room. In terms of the personas, the largest persona today for us is hedge funds and venture funds. These are typically folks who are engaged not just in the top 5 assets, but across top 10, but even across top 100 in market cap. So we see a lot of diversification in the book there, and then all the way up to endowments and foundations who are actually purchasing the underlying asset directly, which is a huge difference in how endowments and foundations were looking at the space a year or even 2 years ago.
Somebody wants to jump in? Comment on that as well?
No, I think that you know, people when they hear in crypto KYC, they get scared, thinking, "Oh, this is going to destroy the market." And you know, I'm old enough to remember when you didn't have to do KYC to buy Bitcoin, right? So when I started in the industry in 2016, you could just go open an account with an email and a username and a password, and then go buy crypto. And then obviously that created a massive problem for regulators, because regulators, they basically care about 2 things. You know, if you look across every country, there's 2 common themes that, you know, cut across. One is investor protection. They don't want people to be a scam, which seems to be like a fair thing to want, right? So that you have some degree of understanding of what you're investing, so you're not investing in something that isn't a scam, or somebody's not going to steal money from you, which I think everybody will agree is a good thing to have. The second thing they care about is money laundering, because they know that, you know, money in the wrong hands can actually cause a lot of damage. It could, you know, finance terrorism, finance, you know, purchasing illegal goods. Now there's a war going on in Europe, so you know there's sanctions that they want to enforce because that way they think they're going to stop the war. I don't know if they're going to be successful or not, but at least that's the common thinking, etc. So those are the kind of the 2 things, right? And the only way to kind of, you know, really implement these 2 things is by knowing who people are, and then that's what KYC is: know your customer, right? And then this is not new in crypto. It was introduced starting 2016, 17. And then it's going to be more and more predominant across all the different ways of interacting with crypto, including DeFi, etc. So it's not only just for you know, institutions to come in, but it's also, I guess, for everybody to make sure that they're, you know, playing on a you know, on a financial asset that is safe. So I think that people should not be scared. And you know, when KYC was introduced to crypto, the actual volume of trading went up. It didn't go down, because the more, you know, reassurances that what you're doing is legal and is protected, the more people come into the ecosystem. So introducing KYC and permission networks and, you know, subnets that have, you know, KYC wallets, etc., is only going to make the pie bigger for everybody, because there will be more players that play on the sidelines that will come in. And for everybody that is playing today that is doing not anything illegal, then shouldn't be worried about it, because they will be able to continue doing the same thing.
Yeah, I can only echo that actually, because I mean, again, coming with the Swiss hat on, the FINMA actually has been very progressive actually in sort of really being very open to this new asset class, obviously open to the new technology that it's governed by, but also really enabling like new participants to engage with these kind of assets in a compliant kind of way. So the framework that they've come up with the DLT law, for example, it does enable more direct participation. It doesn't need to be too intermediated either, which is obviously what, you know, a lot of the marketplace is also looking for, because there's a lot of cost and friction in the current system. And so I think the regulator there has really tried to sort of put a bit of pressure on incumbents to actually kind of come up with a new way to introduce, well, traditional assets on-chain, but also legitimize the new asset class, which is crypto.
And Seena, exchanges like the SDX and also Securities, they have a lot of data, right? I think one of the core offerings of Chainlink are these price feeds. Do you think the data layer is currently one of the last missing elements to make this new permission DeFi ecosystem a reality?
Yeah, quite the opposite. I'd say it's actually just the beginning, right? Chainlink, we're in the business of taking Web 2 data and placing it onto these Web 3 networks. And we're most famous for price data just because of the need of it so eminently with the boom of DeFi. And so most of us know us for price data, but that's absolutely not all that we do. We bring all types of data on chain. We recently brought on weather data, which powers a lot of our parametric insurance use cases. We actually just announced something yesterday around flood insurance in Nigeria. And we're going to continue to bring more data sets on chain that people see value in. We see a very large ecosystem effect of the applications that are created once a certain data set's available. And so folks like SDX, FalconX have access to really unique data sets that not only they can monetize on chain, but also can feed the ecosystem, which can create new developments, new solutions, new use cases, and overall is what gets us all here right now. So it's very exciting as we bring on more data providers, just because we all win at the end of the day.
Great.
So jump in there real quick. If you go back up to the bigger picture, institutions, we're talking about how they get in, but why? I mean, if you look at what's going on in a global economy right now, and you've got cash and you're putting it in a bank, what are you getting? Zero. You're not getting much. So I think there's some incentive and some motivation to do something with money and to earn something on it. So when I'm looking at institutions and talking to them, there is a very open dialogue now. I think it used to be very protected. It was ring fenced. It's like, all right, don't talk to us. We're going to get in trouble here. You get companies like this who have the kinds of backing and the understanding of what we need, and now you've got an opportunity. But the permission markets, to me, are powerful. And when you look at that, a ring-fenced market exists in every public. I mean, Swiss Stock Exchange, NASDAQ, New York Stock Exchange go through the mix. This, in essence, has the ability to go globally, which is where we looked at this and thought, that's amazing. So if you're Latin America, if you're in Switzerland, if you're in the US, wherever you want to be, it's very difficult to have access and see different products and opportunities. With the technologies that are coming about, I mean, the proof of reserve with one of the products that we're putting out, when we looked at that, that was huge. Because someone's saying, all right, you've got this great product, you got $1 billion of funny money over here, it's not funny money, being staked, you're going to create this product, you're putting it in this permission market, and there's this great securitized company doing an ID, wonderful. We need to know it exists. And so the validation and the ability to show transparently, look, it's regulated, it's safe, you've got country. I mean, you look at FalconX, I mean, that's a huge company. So I think helping them understand why it's important and the fact that they're putting money and they're losing money, the opportunity cost of not being involved is not a hard use case.
So can I just make a comment? And I apologize if somebody has been in my other panel because it's the same comment I made there, but I see the audience and it's probably very little overlap. But you need to take one step backwards and think, what is that we're solving for here with blockchain, right? And then the best way to think about it, at least in my opinion, is to think about what internet solve and what is the parallelisms of what happened with the internet as a public utility and what's going to happen with blockchain. And if you think about what really was at the heart of what internet did as a public utility was to create these very efficient two-sided markets. And what I mean by this is the following. So if you were an advertiser before internet existed, you had very little options, right? TV, press, and then there was very little segmentation. It was very little ability for you to identify your target audience in an efficient way, right? So that meant two things. It meant people with a lot of money and a broad audience, they will waste a lot of money on advertising. Small people couldn't access the advertising market at all, because if you are a restaurant in a corner in a street in Barcelona, there was no way for you to efficiently advertise before internet existed, period. So you were outside the market. The internet came, and Google and then Facebook and many, they created this very efficient two-sided marketplace where you could do both things. The large people could advertise very efficiently, but the small people could also participate on the advertising market. So it not only created this two-sided marketplace, but it created a long tail of advertising that actually made advertising a much bigger industry than it used to be, as opposed to what people thought at the beginning that the portals and Google were going to destroy the advertising industry. That did not happen. So if the same thing happened with content distribution, with communications, with commerce and things like that. So internet, very efficient two-sided markets that enable long tail, make markets bigger. more accessible. So now if you think about blockchain, public blockchains especially, as the next evolution of the internet as a public utility that has one feature that internet didn't have, which is the ability to transact with something that represents value. And that could be money, that could be an NFT that represents a collectible or art, that could be a security, as we're talking here, it could be, you know, any equity in a company, etc. That's fundamentally what public blockchains do. They enable this, you know, very, very efficient way of transacting with things that represent value. Where do you transact with value? Capital markets, right? Capital markets are where value is transacted, right? You buy securities, you're an asset manager, you sell, you know, investments in your funds to institutional investors, etc. So if you follow the parallelism and public blockchains create the long tail of capital markets, we can have two things happening. One is large institutions and asset managers, they'll be able to distribute their products downstream in a much more efficient way. So today, the KKRs of the world, Apollo, you know, partners groups in Switzerland or other people like that, they'll be able to basically break outside the traditional distribution channels and the traditional buyers, which are institutional investors. But the other thing also happens, like individual investors or small companies will actually be able to access products that were not accessible for them before, whether it's to raise money or to invest on assets that were not accessible at all before. So that's the fascinating thing of what we're trying to solve for here, and those things, you know, capital markets are regulated whether we like it or not. So this means that some degree of regulation and KYC, etc., will have to come into blockchain for this vision to become a reality.
I was just going to add something because I couldn't agree more, Carlos. But the other thing that you sort of mentioned, which triggered something in me, is that the value transfer. So we started, as you said, with the internet, and you'd created that two-sided market. Of course, you could already do online payments back then, but it wasn't, you know, quite the same. It had to go through that intermediary step to go end-to-end between the buyer and the shop. But now what you've got is, it's sort of fascinating, really. It's you got the value that is actually embedded in the technology. Previously, you've had obviously core banking systems that are managing, like, let's say, the value, but the value is actually outside the system. Here, the value is in the system, so it's really taking out a lot of the friction, and it's making it much more maneuverable. And that's also what's got capital markets fascinated by blockchain, of course, and they're still trying to get their head around exactly how to, you know, bring themselves in, which is obviously part of the panel today. Like, how do you bring institutions or banks even more into this space? And so it's got them interested. And from our side, for example, at SDX, we've also seen, we started more on the capital market side. We sort of wanted to solve for certain pain points. But now we've seen also that the crypto is actually the other side of this infrastructure. So basically, you're building digital market infrastructure that's coming on the regulated side, but also from the unregulated side. And the truth and the convergence will probably happen somewhere in the middle, and it'll be fascinating to see how that unfolds.
And just a quick point on this to kind of bandwagon and follow up on everything that was said. Why is this important for institutions specifically? If you think about who these institutions are, really peg against endowments and foundations. If you look at retirement accounts in the United States, in other countries today, a lot of these asset managers are looking for maybe 1% to 2% returns in order to provide people their retirement funds, their 401k accounts. In a market with 7% inflation, that's going to be very difficult. On average, last year, most hedge funds returned negative 30% in the market. And so when you're really thinking about the opportunity cost of not getting involved today, it's not just how do I return 1% to 2%, it's how do I return maybe 5% so that when folks who now live older today and work longer are able to have a retirement account when they retire. I think the definition of institution sometimes is really pegged to a hedge fund or a venture fund, but who invests even in these funds? A lot of it are retirement accounts that are just trying to, give and provide at the end of someone's career.
I just want to touch on some of the work we're doing at Bridge Tower and our proof of reserve solution. So Chainlink, we utilize our decentralized Oracle network to verify the collateral that's backing these tokenized assets that are produced within a securitized, for example. And so what this enables us to do is we're able to bridge from chain to chain. So we're wrapping an asset and verifying the collateral. We do this with multiple different node operators in a decentralized way, and we also provide a transparent way to audit these solutions. So auditors are integrated into the solution, so there's real-time attestation occurring. So it provides the confidence back not just to the auditors and your attestation reports, but also for the users that are utilizing these assets. So when people can utilize these assets, there's a trustless way to actually verify what this is actually backed by, as opposed to taking someone's word by it or finding a bottleneck, if you will.
Sounds like a smarter repo market almost.
So, yes, 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 and yes. Multiple comments. You know, the blockchain, as you go out and you talk about these new products and offerings, you have to start at the blockchain. And I think everybody's kind of hitting on that. That's the premise of everything we're doing. And I think sometimes we go so deep into explaining the nuances that people are lost. So with institutions, it starts right there. What is the blockchain? How does it operate? I mean, you talk about the ability of, you know, transparency, immutability, global exposure, the creation of products, you know, the laws in Switzerland being so favorable and what you can do with it. But I think we miss the fundamental issue of telling people what it is. We say institutions. What's an institution? Well, it's anybody with money that can pass KYC and accredited investor checks, depending on which way you're going to go with securities. And we found, you know, the collaboration with the institutions has been fun. I mean, they want in. They're trying to discover ways to get in. I think the permission markets, I think everything we've talked about being redundant is powerful. But I'm going back to opportunity cost, because if I can explain what the blockchain is globally, compliantly, you have access and you have the opportunity to see things. I mean, we've got some good friends here from Latin America we're doing some deals with. This little company called SensiNode, who we're excited about. Sorry, a little call out for them. But what you can do is safely and compliantly offer a return. And I think helping, you know, a year and a half ago when we started talking about permission markets, we were the ugliest company out there. We still might be, I don't know, but at least we have a little bit different premise. The permission market protects, it enables, and it enhances it, and it gives you truly a viability to go across interoperability. And I don't know interoperability is being done very effectively yet. And I think that, to me, is the next big movement where you can see, you can access, and Carlos said it. Now, before, how many people are truly going to get access to these types of products? 5 years ago, 3 years ago, 2 years ago, not many. You now have the opportunity for viral marketing. Viral marketing is the single most powerful marketing mechanism out there. I trust you, if you're in, I'm in, and it just proliferates. So
I think we're sometimes obsessed about bringing institutions to crypto and DeFi, but the other way around, the opportunity of bringing traditional inaccessible finance products in a very streamlined way to individual investors is equally big. In the US, everybody complains, oh, well, there's a lot of products that are only for accredited investors. That's true, but last year, for the first time, 10% of the population became accredited investors. So you're talking about 10% of population is around 13 million people. Collectively, these 13 million people, they manage $75 trillion. And those people, for the most part, they don't have access to a lot of stuff because they, you know, as you were talking about retirement plans, you know, they're managed by somebody else, the performance are terrible. So being able to bring good investment products in a very streamlined way to these people, which a lot of them, they don't want to deal with traditional wealth management and you know, bankers and stuff like that. They want to take their own investment decisions. And I think this became very clear with the rise of Robinhood, the rise of crypto itself, where people are capable of investing by themselves. So if you can add to the mix a bunch of other products in, you know, on a blockchain in tokenized form in a very, you know, accessible way with some liquidity, etc., that opens up a huge, you know, investment money that flows back into markets that doesn't exist today. So.
I think this is a very meaningful point, right? So technology in general is very powerful. And the largest rate of exponential growth of innovation is currently happening in the blockchain space. And your point as well, Aya, with all the technology and all the yields currently in the space, by enabling these permission markets, you're at the end serving the society because pension funds and everybody can participate. So at the end, to pay the pensions for a lot of people, now they need to participate in technology in the broader sense. And I think this is the powerful point here. Yeah. We have 5 minutes left. Cory, I come back to you real quick and to the point of your staked digital asset securities. I think this is one of the products currently offered to a broader set of institutional investors to serve exactly that need.
So we looked at two kinds of products. There's securities, which Carlos mentioned. There's a lot of people coming into them. A permission, no one can, you have to be licensed to sell and offer a security. Not many people are. So having the ability to partner with these groups where you can participate in a permission market for securities, and we are using a staked asset, securitized, wrapping it in a compliant way. You come through an ID, you have Chainlink doing proof of reserves, you're in a permissioned, closed, ring-fenced marketplace. You purchase that. You know, we talk about delegating to staking, and we've got about 5,000 of our own nodes on 100% renewable energy in Switzerland. It's our own bare metal. And we wanted to take those and utilize those in a meaningful way. Well, you have to have the right smart contract, you have to have the right licenses, and you have to be in a place to ring fence those. But the beauty is, if you purchase a product like that, why just stake? Because you've staked and you've purchased in token, a security token that within a year you can sell. So you're getting the best of both worlds in some of these creative products. The other permission market that we did was for utilities. So swaps, liquidity pools, and then NFTs. So we got heavily into NFTs, which Tim and I think Tim spoke for 9.5 minutes and I nodded for 5 minutes. He's pretty good. We're doing a Goya, which is pretty exciting. Everybody in the Avalanche conference will get a Goya, one of his most famous paintings, and a series of 80 Goyas will roll out. That's going to be in a permission market because it's such a prominent, powerful, meaningful product in the form of this NFT. You want to protect it. You want to keep it in there. Well, same principle. KYC goes in. If you don't need accredited investor checks, you can go onto this other exchange. You can do swaps. You can buy NFTs. You can put different financial products in. So there's multiple use cases as well.
Any last words? Otherwise, we are more or less perfectly in time. Carlos, some last words from your side? We have 2 minutes left. One question or two questions out of the audience. Yeah, please go ahead. So very good question. At the end, the question is, let me quickly repeat it. The question was, if you have these ring-fenced environments, these ring-fenced DeFi environments, how can you ensure that there are not intermediaries happening, which is more or less bringing the whole old system back to the chain?
That's a very good question. So first, you know, there's going to be a pure 100% decentralized market. It's very unlikely that it survives the regulatory approvals because, you know, precisely by being 100% permissionless and anonymous is going to enable money laundering, scams, and stuff like that. So now the other extreme is TradFi, where you have a lot of intermediaries that they're just fighting to keep their position safe, right? I think we're going to land somewhere in between, where there will be some intermediaries that are primarily regulated entities that will do KYC, etc., but they will do it in a way that is very decentralized and much more streamlined. And going back to my analogy with internet didn't eliminate intermediaries, it just created better ones, right? So before, if you wanted to advertise this, you had to go through a television channel. Now you have Google, which at the end of the day is still an intermediary, but it provided a much better service, you know, much more democratized, cheaper, more efficient, etc. So I think that somewhat we're going to land in somewhere in between. In crypto. It's not going to be 100% permissionless, decentralized, no intermediaries, but it's not going to be the crap that we have now. I'll just give you one very simple example of what we do today as a transfer agent, which to some extent we're an intermediary, right? We have the same license that a traditional transfer agent. A transfer agent is a regulated entity that manages securities for issuers, and does things like pay dividends, okay? So when a company like Apple pays a dividend, they go to a company called Computershare, and they wire them the money, and then Computershare figures out how to pay the money out. Now, that process has an intermediary, but now the intermediary is incentivized to make the process as inefficient as possible because the money sits in their bank account and they earn, a float on the money that they haven't been paid as a dividend. And in particular, in the case of computer shares, it's 50% of their profit, 50%. Now, what they do, they mail checks, they mail it to the wrong people, they don't know who the beneficial owners of the securities are, so they use another intermediary called Broadridge to, get to the list of who has securities, etc. It's like an extremely inefficient way of doing it. The way we do it is, well, we know in real time who the beneficial owners are of the securities because we track them on the blockchain. There's wallets attached to it. We just pay a dividend where we basically airdrop USDC into the wallets of people instantly. It was all done on the blockchain, decentralized, but we still work we want the intermediary gatekeeper of the operation from a regulatory perspective, but we've eliminated 99% of the problems of the traditional intermediaries. And I think that's what's going to end up happening.
I'll just give one more example, which is it's very difficult to build technology for a wide spectrum of personas. So for example, if you take trading as just one example, I agree that we'll probably land somewhere in the middle. But if you look at trading specific in crypto, over 50% of it actually happens in dark pools today that you don't see in exchanges or you don't see on order books, you don't see on the blockchain. And that's because even if you look at specifically Luna that's trying to purchase 150 million of Bitcoin, that's a very difficult thing to do in one point in time. You have to TWAP it, VWAP it, or you find natural buyers and sellers for it. When we get asked to purchase $200, $300 million worth of an asset class, it's a very, very difficult thing to do in a decentralized way in an open market. And so the technology that you'll find for like a retail persona relative to a massive prop shop is going to be very, very different, and we'll probably land somewhere in the middle for the right reasons, which is you don't want a $300 million order sitting on an order book or going through a DEX. The slippage you'd get on that and the impact to market prices would just be enormous.
90% of the biggest companies in crypto are centralized intermediaries. OpenSea, Coinbase, you name it. FTX, Binance, that's what they do. They're just better intermediaries maybe than the ones that we had before, but
Seena, Chainlink, you've got some solutions for this.
We got solutions for everything. We do, yeah. Putting it on chain, using a trustless way to do so, doing it in a cryptographic way. At the end of the day, it's probably the only way it can be properly done at the scale that we want it to be. So,
thank you very much for this question. Very good question. Thank you, everybody, and thanks to the panelists.